If you ever looked at a company's financial statements and sort of wondered how they managed to use all that expensive equipment or massive office buildings, even fleets of vehicles, without actually owning them, it's kind of like seeing someone drive a really fancy car and realizing, wait, they don't legally own it, but they get all the benefits of driving it around. What looks like a simple deal renting, leasing, is actually, well, it's a fascinating and really crucial area of financial reporting, especially when you're the one using the asset. So today we're doing a deep dive into something absolutely vital if you want to truly grasp how modern businesses work and report their assets, lessee accounting. We're going to pull back the curtain on the definitions, the key classifications, and the financial reporting secrets that govern how companies, as the users of these assets, account for these critical agreements.
Yeah, absolutely. Our mission today is really to give you a clear, comprehensive grasp of how companies, specifically as lessees, weave their lease agreements into their financial world. We'll try to simplify the tricky parts, pinpoint what really matters for your understanding, and hopefully make sure you walk away with those valuable aha moments, where you feel genuinely informed and can spot these concepts out in the wild. Think of it as your shortcut, maybe, to decoding a pretty big piece of any company's financial puzzle. And we're drawing our insights from the most authoritative accounting guidelines out there, really designed to give you the clearest, most practical picture.
Okay, let's start at the beginning then. What exactly is a lease? At its heart, it's a contract, right? An agreement allowing one party to use an asset someone else owns. You've got the lessor, that's the owner, granting the right, and the lessee, that's the company or person, paying for that right over a set time. It's fundamentally about getting access to and control over an asset without taking on all the risks and burdens of owning it outright.
That's why you see it everywhere, right? From airlines leasing planes to like a small coffee shop leasing its espresso machine.
Exactly. And what's really interesting here is that the definition, for accounting anyway, goes way beyond just a simple rental agreement. For a contract to actually qualify as a lease, or even just contain a lease part, it has to meet two very specific, very crucial criteria. These aren't just, bureaucratic hoops. They're designed to make sure financial statements accurately show when a company truly gains control over an identifiable asset. If a contract doesn't tick both these boxes, it might just be a service agreement or something else entirely, and that has totally different accounting effects. Okay, so what are these two criteria? Let's break them down.
Right. So the first one is the contract must depend on a specific identifiable asset, and crucially, the lessor must not have a substantive substitution right. Identifiable asset. What does that mean? Well, it means the asset is clearly spelled out, maybe by a serial number, or it's implicitly specified because it's the only thing that can do the job. You're not just leasing a server, you're leasing that server in Rack 3, Bay 7. Now, the no substantive substitution right bit, that's where it gets a little more nuanced. It means the lessor can't just swap out the asset for a similar one whenever they feel like it, at least not easily or without it costing them something significant.
So if they can swap it easily,
Yeah.
and it actually makes sense for them economically to do so.
Exactly. If they have that practical ability and benefit from swapping it, then you, the lessee, don't really control that specific asset. Their right to substitute has to be real, substantive, not just some clause buried in the contract. It ensures you're really tied to that unique asset.
Okay, identifiable asset, no easy swapping by the owner.
Yeah.
Got it. What's the second criterion?
The second one is just as vital. You, the lessee, must have the right to control the use of that asset throughout the lease term and get substantially all the economic benefits from using it. So, control. What does that really mean here? It kind of boils down to two things: directing how the asset is used and deciding when and where. Like, if you lease manufacturing equipment, you decide what it makes, what hours it runs, who runs it. You're not just buying a service where the lessor tells you what you get. You're directing the asset's core operations.
And the economic benefits part.
Right. Substantially all the economic benefits means you're getting the vast majority of the value from using that asset. That could be cash flowing in from its output, or maybe significant cost savings because you're using it. It's more than just having it physically. It's about the decision power and capturing the value it creates.
Okay, let's make this real. We have an example from our sources involving Bentley Corp. And Riggs, Inc. Riggs wants to use some specialized scientific equipment, book value $75,000 for 5 years. Bentley, the owner, puts a clause in saying they can replace this specific equipment with something comparable during the 5 years. But, and this seems key, Riggs gets to use it however they want during those 5 years, deciding its schedule, its output, and they keep all the cash generated from what the equipment produces. So with that substitution right sort of hanging there, does this count as a lease for Riggs?
This is a perfect scenario. It really helps unpack that Substantive substitution right idea. Let's break it down. First, is there an identifiable asset? Yes, clearly that specific piece of scientific gear. Now, about Bentley's right to substitute. On the surface, it sounds like it could be substantive, right? But the key is Riggs still directs the use of the asset however they wish, and crucially, they get all the economic benefits. For Bentley to actually swap it, it would likely be costly or disruptive for Riggs, which probably means Bentley wouldn't gain much economic benefit from doing it. Remember, for that substitution right to negate the lease classification, the lessor needs the practical ability to swap and must benefit economically from doing so.
So Bentley's right probably isn't substantive in practice here.
Exactly. It seems unlikely here because Riggs keeps the control over use and gets all the value. And second, Riggs clearly has both elements of control, directing use and getting the economic benefits. So yes, this highlights how both criteria identifiable asset and lessee control benefits really have to work together. It qualifies as a lease.
Okay, makes sense. So once you've figured out, yes, this contract is a lease or at least has a lease component in it, you're not done, are you? You mentioned needing to dissect the contract further. This happens right at the beginning, at inception.
Right. At the inception date when the contract becomes enforceable. And that initial assessment generally sticks unless the contract itself is modified later on. And this dissection is crucial because it directly impacts how different parts of the agreement get accounted for. So, from the lessee's side, once you know there's a lease involved, there are basically three things you need to figure out. First, do you need to combine multiple contracts? Sometimes agreements are split on paper but are really one deal in substance. You need to check for that.
Ah, okay. To prevent companies from, gaming the system by splitting things up.
Precisely. Second, within a single contract, you need to spot any separate lease components. Like if you lease a building and the land it's on, those might be two separate components. And third, if you have lease components and other things bundled in, say, maintenance services with equipment, you need to decide whether to account for those non-lease components separately or combine them with the related lease component. Every decision here changes the numbers.
Okay, let's talk about combining contracts first. When do you do that? It's not just a feeling, right? There are rules.
Oh, definitely rules. Our sources lay out specific criteria. They need to be entered into around the same time, involve the same parties or related ones, and meet one of these three conditions. One, the performance or price of one contract affects the price or performance of the other. They're linked. Two, they have the same overall commercial objective and were clearly negotiated as a single package deal. Or three, the rights themselves wouldn't qualify as separate lease components if viewed individually, meaning they only make sense together. If those conditions are met, boom, you treat them as one contract for accounting.
Got it. So after you've dealt with combining, or not combining contracts, you look inside a single contract for separate lease components. You said there's a two-step dance.
Yeah, pretty much. Step one is just identifying every distinct right to use an underlying asset in the contract. If there's just one right, easy. But if there are multiple several machines or a building and land you need to assess each right, is a right separate? Well, it is if two things are true. First, the lessee can benefit from that right either on its own or with other resources they already have available. Second, the rights aren't highly dependent on or highly interrelated with each other.
Like your example of two machines, if one works fine without the other, they're separate. But if they only work together on a production line, they're dependent.
Exactly. And a stuccal note here, often overlooked. The right to use land is almost always treated as a separate lease component, unless the accounting impact is truly tiny. Land is just different, you know?
Okay, step one, identify the separate rights. What's step two? You mentioned a choice.
Right. Step two is where the lessee gets an option, but only if there are also non-lease components involved, like that maintenance service bundled with the equipment lease. Once you've identified your separate lease components, like the equipment, you have two ways to handle the related non-lease components, like maintenance. Option one, keep everything separate. Account for the equipment lease distinctly from the maintenance service. Very granular. Option two, combine them. Treat the equipment lease and its related maintenance service as a single combined component for accounting purposes. This simplifies things.
Ah, okay. So companies can choose the approach that makes more sense for their reporting.
Yes. Within the rules, this practical expedient offers flexibility. It allows companies to choose a presentation style, either detailed separation or simplified combination.
Regardless of which option you pick, you still need to allocate the total money involved, right?
Yeah.
The total consideration.
Absolutely. You need to figure out the total consideration first. That's basically all your lease payments plus any other required payments in the contract, but minus any lease incentives you get back from the lessor. Once you have that total amount, You allocate it across your components, whether separated or combined, based on their relative standalone prices.
Standalone prices, meaning what they would cost if you leased or bought them separately.
Exactly. If you can observe those prices in the market, that's the best way. If not, you use your best estimate. This ensures each piece gets a fair slice of the total contract pie, reflecting its individual economic worth.
Okay, this sounds like a good time for that Fast Science microscope example. Let's walk through it. Fast Science leases 2 electron microscopes, FE and SQ, to a university for 4 years. Monthly payments are $7,750 for FE, $8,600 for SQ. Bundled maintenance is included, not paid for separately. We know the standalone prices. FE microscope $400K, SQ microscope $450K, FE maintenance $30K, SQ maintenance $35K. Total hypothetical standalone $950K. The actual total cash the university pays over 4 years is $784,800, $16,350 total monthly by 48 months. So how does the university allocate this $784,800?
Perfect. Let's look at the two scenarios based on the university's accounting policy choice. First, they determine the microscopes are separate lease components and the maintenance services are non-lease components. Scenario 1, keep lease and non-lease separate. Here, they allocate the $784,850K, about 43.7%. SQ is $450K, $915, about 49.2%. FE maintenance is $30K, $950K, about $43.2, about 3.3%. SQ maintenance is $35K, $915K, about 3.8%.
Okay, so you get the percentages.
Right. Then apply those percentages to the actual $784,800 consideration. So microscope FE gets allocated roughly 43.7% of $784,800, which is about $343,000. Microscope SQ gets about 49.2%, around $386,000. FE maintenance gets 3.3%, about $25,900. And SQ maintenance gets 3.8%, about $30,000. See how each piece gets its own value? Very distinct reporting. Scenario 2, combine lease with related non-lease components. Here, the university uses that practical expedient. They combine microscope FE plus maintenance FE into one F unit, $400K plus 30K plus 30K over 430K standalone. And microscope SU plus maintenance SQ into one SESQ unit, 450K plus 35K is about 45K. The total standalone value is still $915K.
Okay, so now you have 2 units to allocate.
Exactly. Calculate new percentages. FE unit gets about 47%, roughly 368,856 goes. SG unit gets about 53%, roughly $415,944.
I see. The total allocated amount, $784,800, is the same in both scenarios.
Precisely. The total is identical. The only difference is the internal allocation and how it's presented. Scenario 1 gives you that super detailed breakdown. Scenario 2 gives a simpler, aggregated view. It really shows how that accounting policy choice impacts the look of the financials, even though the overall economics are the same. It's about presentation within the rules.
Okay, this next part feels really critical classifying the lease. Is it operating or finance? You said this fundamentally changes the accounting.
Oh, absolutely. This is probably the single biggest decision point for a lessee. It drastically changes how the lease hits your balance sheet and income statement. Think of a finance lease as being very similar to buying an asset with financing. You put a significant asset and liability on your books, reflecting that you've taken on most of the risks and rewards of ownership. An operating lease, while it still results in an asset and liability on the balance sheet under current rules, aims for a smoother, more level expense pattern on the income statement, more like traditional rent.
So what's the test?
It all hinges on whether substantially all the benefits and risks of ownership are transferred to the lessee. And to figure that out, we use the ONOS criteria. It's a mnemonic, ONOS. The rule is simple. If the lease meets any one of these 5 criteria, just one, it's classified as a finance lease. If it meets none of them, then it defaults to an operating lease, unless it's a very short-term lease, which we'll touch on. These ONS criteria are designed to look past the legal form and get to the economic substance of the deal.
Okay, ONS. Let's go through them. O
is for ownership transfer. Does the lease agreement explicitly say ownership transfers to the lessee by the end of the term? If yes, finance lease. Simple as that. You're basically buying it. W is for written purchase option. Does the lessee have a written option to buy the asset, and are they reasonably certain to exercise it? This isn't just any option. It has to be highly likely they'll buy it, maybe because the price is a bargain compared to the asset's expected future value. If that certainty is high, it signals intent to own. Finance lease. N is for net present value, NPV. This is a big quantitative test. Does the present value of all the lease payments, plus any guaranteed residual value the lessee owes, equal or exceed substantially all of the asset's fair value at the start? The logic is, If the PV of what you're paying covers almost the entire value, you're effectively financing the purchase.
Okay, but substantially all. It sounds a bit vague. Is there a number we can use? A benchmark?
Great question, because substantially all does feel subjective. While the newest standards aren't always explicit on the percentage, common practice and previous guidance point strongly to a benchmark. 90% or more of the asset's fair value.
90%. Okay, that's concrete.
Exactly. So if your PV calculation hits 90% or more of the fair value, the N criterion is met. Finance lease. It removes a lot of the guesswork.
Got it. Next is E.
E is for economic life. Does the lease term cover the major part of the asset's remaining economic life? This looks at duration. If you're using the asset for most of its useful lifespan, you're getting most of the ownership benefits.
And major part. Is there a benchmark for that too?
Yes, similar idea. Common practice suggests 75% or more of the asset's remaining economic life. If your lease term hits that 75% mark or higher, E is met. Finance lease. Our sources also note, kind of relatedly, if a lease starts when an asset is really old, like only 25% or less of its total economic life is left, it's less likely to trigger this E criterion. You're just using the tail end.
Okay, 75% for economic life. Last one, S.
F is for specialized asset. Is the asset so specialized, so custom built, that it probably won't have an alternative use for the lessor after your lease term ends? Think custom manufacturing equipment for your specific process, or a building with unique modifications no one else would want. If the lessor can't easily lease it again or use it themselves, it means you, the lessee, have effectively consumed its unique value. Finance lease.
Okay. Ownership, written option likely, NPV, 90% plus. Economic life, 75% plus. Specialized asset. And if any of those are yes, it's finance. If all are no, it's operating.
Exactly. You walk through them in order. OWNES. Hit a yes anywhere, you stop, it's finance. Get no all the way through, then it's operating. It provides a clear path.
Can we see the N test, the NPV one with numbers?
Sure. Let's use that example. Lease equipment, fair value, $3,500. Payments are $1,000 a year for 4 years, end of year, asset life 10 years. Your borrowing rate is 10%. No ownership transfer, no purchase option, not specialized. So we test N. Calculate the present value of 4 payments of $1,000 at 10%. Using PV factors, that comes out to $3,170.
Okay, $3,170.
Now compare that to the 90% threshold. Fair value is $3,500, is more than the 90% threshold of $3,150.
Precisely, because $3,170 is greater than $3,150, the N criterion is met. Therefore, this lease must be classified as a finance lease. Shows how a small difference can tip the scales. Got it. Okay, another scenario. Landon leases furniture to Haley Inc. It's a 7-year lease. The furniture's economic life is 9 years. No ownership transfer, no purchase option. And the PV of payments is only 80% of the fair value. So for Haley, finance or operating.
All right, let's run Haley through ONIUS. O, ownership, no. W, written option, no. N, NPV. PV is 80%. That's less than the 90% threshold, so N is not met. E, economic life. Lease term is 7 years, economic life is 9 years. So 7 divided by 9, that's about 78%.
78%, which is more than the 75% threshold for major part.
Bingo. The E criterion is met because 78% is greater than 75%. S, specialized. Unlikely for standard furniture, let's assume no. So even though the NPV test failed because the economic life test passed, Haley must classify this as a finance lease. It really hammers home that you only need one yes from ONI.
That's a great point. Okay, so we know how to classify. Now let's get into the nitty-gritty. Calculating the actual lease term and the lease payments for accounting. How long is the lease officially?
Good question. The starting point is the commencement date. That's when the lessor makes the asset available for you to use. The lease term then officially covers the non-cancelable period.
The time you're legally locked in.
Pretty much. But it gets more nuanced. The term also includes periods covered by options to extend the lease, if the lessee is reasonably certain they'll take that option. And conversely, it includes periods covered by options to terminate the lease if the lessee is reasonably certain they won't exercise that termination option.
So certainty about options matters a lot.
Absolutely. If you have a 5-year lease with a 2-year extension option, and you're almost positive you'll extend, maybe moving is too expensive, then your lease term for accounting is actually 7 years. And importantly, if the lessor controls an option to extend or terminate, those periods are automatically included because you, the lessee, can't stop them. Getting this term right is critical because it affects the period over which you recognize the ROU asset and liability.
And what about short-term leases?
Right, the exception. If the lease term, after considering all those options, is 12 months or less, and there's no purchase option you're likely to exercise, it's a short-term lease. Lessees can then elect a simplified accounting, basically. Just expense the payments, no ROU asset or liability needed. Big simplification.
Okay, lease term figured out. Now, what exactly goes into the lease payments calculation for the ROU asset and liability? Is it just the monthly rent check?
Ha, it's only it were that simple. No, the lease payments calculation is quite comprehensive. It aims to capture the full economic commitment. It includes, first, required fixed payments. Your base rent, definitely. Also includes any variable payments that are in substance fixed, meaning they're unavoidable even if the amount changes predictably. And you subtract lease incentives received here. Second, the exercise price of a purchase option, but only if you're reasonably certain to exercise it. Third, any stated purchase price if the lessor requires you to buy the asset at the end. Fourth, indexed or rate-based variable payments, like payments tied to CPI or an interest rate. Crucially, you measure these using the index rate at the commencement date and don't predict future changes. Differences later get expensed as they happen.
Okay, so no crystal ball needed for CPI changes.
Right. Fifth, the full amount of any residual value guarantee you expect to owe. If you guarantee the asset will be worth $6 at the end and you think you'll have to pay up, that expected payout is included. Unguaranteed amounts are not included. And finally, any termination penalties you're reasonably certain you'll incur if you plan to terminate early.
So what's definitely out of that calculation?
Good point. You exclude guarantees of the lessor's debt, and you exclude other variable lease payments that aren't based on an index or rate-think payments based purely on how much you use the asset or your sales volume. Those are generally expensed as incurred.
Let's try the Sterling example. Leases equipment, 8-year life, 3-year lease term, monthly payments, $3,450. But wait, the first 4 months are free. There's a purchase option for $12,500. But Sterling thinks it's unlikely they'll use it. And there's $8,000 separately allocated for maintenance. How do we calculate Sterling's lease payments?
Okay, let's dissect this. We only include the $3,450 fixed monthly payments for the months they actually pay. It's a 36-month lease, but 4 are free. So 32 paid months. That's $3,450 times 32.
32 months, right?
The $12,500 purchase option, out. Sterling isn't reasonably certain to exercise it.
Okay.
The $8,000 for maintenance, also out. It's a separate non-lease component. So the lease payment calculation for the liability and ROU asset is simply 32 times $3,450. It clearly shows how you filter out the uncertain bits and the separate services.
Got it. What about that variable payment example, Bowden Corp? Lease A tied to CPI, lease B tied to asset usage. How are they treated differently in the calculation?
This is a crucial distinction. Lease A, with payments based on CPI, those are included in the initial lease payment calculation. Why? Because they're tied to an external index. You use the CPI rate at commencement to set the initial payment amount for the calculation.
Okay, index based or in.
Lease B, with payments based on usage. Those are not included initially. They're too unpredictable, completely dependent on future activity. So those usage-based payments are simply expensed in the period they actually happen. It shows that variable isn't one category. The type of variability matters hugely for capitalization versus expensing.
Makes sense. Now, for all these present value calculations, which discount rate does the lessee use? The lessor's implicit rate or their own borrowing rate?
Good question. Choosing the rate is key. The lessor generally uses the rate implicit in the lease. The lessee should use that implicit rate too if they can readily determine it. Sometimes the lessor tells them or they have enough info to calculate it.
But if they don't know the implicit rate?
If it's not readily determinable, which is common, the lessee uses their incremental borrowing rate. That's basically the rate they'd have to pay to borrow funds for a similar amount over a similar term with similar collateral in the current market. Using the incremental borrowing rate ensures the PV calculation reflects the lessee's specific cost of funds and credit risk.
Okay, one last piece before we get to journal entries. Those are the initial direct costs. Legal fees, commissions to get the lease signed, do they get added to the ROU asset?
Yes, but with a catch. Initial direct costs are included in the ROU asset's value, but only if they were incurred as a direct result of executing the lease. Costs that wouldn't have happened without that specific lease getting signed.
Like the broker's commission for that deal.
Exactly. Or legal fees for drafting that final contract. But costs incurred before signing negotiating terms, initial credit checks, general admin looking for space, those are expensed as incurred. They aren't directly tied to creating the ROU asset itself. It's about costs that directly enable the lease commencement.
Okay, crystal clear. Now let's finally see how this hits the books. Let's start with operating leases. How do they actually look in the journal entries and on the statements?
Right. For an operating lease, the goal is consistent expense recognition on the income statement while still putting an asset and liability on the balance sheet. On the balance sheet, you record a right of use, ROU asset, and a lease liability. Both are initially measured at the present value of the lease payments using that appropriate discount rate. Over the lease term, the liability is reduced, usually using the effective interest method, and the ROU asset is amortized. Generally, they decrease kind of in sync.
And the income statement for operating.
This is the key difference. On the income statement, you see a single combined lease expense. And crucially, this expense is recognized straight line over the lease term, same amount each period. The interest component on the liability, it's buried inside that single lease expense number. It's not shown separately. So the P&L impact looks smooth, like traditional rent expense, even with the balance sheet items.
Okay, that straight line expense is key for operating. And you mentioned paying attention to when payments are made for the PV calculation, beginning versus end of period.
Absolutely crucial. A passkey for calculations. Payments at the beginning of period mean it's annuity due. Payments at the end of period mean it's an ordinary annuity. The PV factors are different. Using the wrong one messes up your initial ROU asset and liability. Always double-check the payment timing in the contract.
Let's do that operating lease example. 3-year lease, $18,000 annual payments. First payment at end of year 2, so ordinary annuity. Rate is 5.75%. January 1, year 2 commencement. PV factor is 2.685424. What are the entries?
Okay, step by step. January 1, year 2, commencement. First, calculate the PV. $18,000 payment, 2.685424 factor equals $48,338. The entry is debit RU asset $48,338. Credit lease liability $48,338. Establishes the asset and liability on the balance sheet. Simple start, December 31, year 2, first payment and expense. End of year, pay $18,000. For an operating lease, we want a straight line expense of $18,000 on the income statement. Now, the underlying mechanics. Interest for year 2 is 5.75%, $48,338 liability equals $2,739. The cash note of $18,000 reduces the liability principal by $18,000, $2,779, $15,221. The ROU asset amortization plugs the gap to make the total expense $18,000. So amortization is $18,000 total expense, $2,779 interest, $15,221.
So what are the actual journal entries for year 2 and...
Two parts, essentially. One, record the payment and liability reduction. Record the payment and liability reduction. Debit lease liability, $15,221, 1 cent. Record the payment and liability reduction. Credit cash, $18,000. 1. Record the payment and liability reduction. Interest expense isn't explicitly debited here for operating leases. 2. Record the straight line expense and amortize the ROU asset. 2. Record the straight line expense and amortize the ROU asset. Debit lease expense, $18,000. 2. Record the straight line expense and amortize the ROU asset. Credit accumulated amortization ROU asset, $15,221. See, the income statement just shows that single $18,000 lease expense, the interest is embedded.
And for the next years, year 3 and year 4?
Same pattern. The interest component calculated on the declining liability will get smaller each year, but the lease expense on the income statement stays fixed at $18,000. The ROU asset amortization will adjust each year to make that happen. It keeps the P&L smooth. By the end of year 4, everything nets to zero.
Okay, very clear for operating. Now switch gears. Finance leases. How does the accounting differ? More like that installment purchase idea?
Exactly. Finance lease accounting reflects that ownership-like substance much more directly. On the balance sheet, you still have an ROU asset and a lease liability, but the initial ROU asset value often includes more. The PV of payments, plus initial direct costs, plus any payments made at or before commencement, minus incentives. It's a fuller capitalized cost.
And the income statement is where the big difference lies.
Absolutely. For a finance lease, you see separate line items on the income statement. Interest expense on the lease liability, calculated using the effective interest method, so it usually decreases over time. Amortization expense for the ROU asset, typically straight line over the relevant term, so often constant each year. This separation clearly shows the financing cost, interest, and the asset consumption cost, amortization. Much more transparent about the components.
Let's use the same basic facts. $18,000 annual payments, 5.75% rate, 3 years, payment at year end. But now it's a finance lease. Assume straight line amortization. How do the entries change?
Okay, finance lease time. Initial PV is the same, $48,338. Straight line amortization over 3 years is $48,338, $330,000 per year. January 1, year 2, commencement, debit ROU asset, $48,338. Credit lease liability, $48,338. Initial entry looks the same. December 31, year 2, first payment and expense. Here's the split. Interest expense is calculated first, 5.75%, $48,338 liability, $2,779. Cash payment is $18,000. Principal reduction is $18,000. $2,779, $15,279. Now the two separate entries. One, record interest and payment. One, record interest and payment. Debit interest and payment, debit interest and payment, record interest and payment, debit lease liability, $15,221. See, interest expense is explicitly debited. 2, record amortization. 2, record amortization, debit amortization expense, $16,113. 2 cents, record amortization. Credit accumulated amortization ROU asset, $16,113.
Okay. So the income statement gets hit with both interest expense, $2,779, and amortization expense, $16,113 separately.
Exactly. 2 distinct expense lines, unlike the single line for operating leases.
And for subsequent years in the finance lease.
Same separate entry structure. The interest expense will decline each year as the liability balance drops. The amortization expense stays constant at $16,113, assuming straight line. This means the total expense recognized for a finance lease, interest plus amortization, is typically higher in the early years and decreases over time. That front-loaded expense pattern is characteristic of finance leases.
Let's quickly look at that finance lease example with the initial direct costs. 8-year lease, initial payment $35K on Jan 1 year 5, plus $12K initial direct costs. Remaining payments $35K annually, 4.5% rate. What's that commencement entry again?
Right, this shows how the ROU asset builds up. First, the liability. PV of the remaining 7 payments of $35K at 4.5% is about $206,245. That's the liability. The ROU asset includes, that liability meant, $206,245. 2 cents, the initial payment. $35,000, 3 cents. The initial direct costs, $12,000. Total ROU asset equals $206,245 plus $35,000 plus $12,000 plus $12,000, $253,245.
Okay, so the entry.
The entry on Jan 1, year 5 is debit ROU asset, $253,245. Credit lease liability, $206,245. Credit cash, $47,000 for the $35K payment plus $12K costs. Clearly shows how those upfront costs and payments boost the asset value immediately.
That makes sense. So thinking bigger picture, the total expense over the entire lease life, is it ultimately the same for finance versus operating, just recognized differently?
That's exactly right. It's a critical point. Let's take that year 6 expense for the finance lease we just set up, amortization. $253,245 dive ROU asset, 8 years, equals $31,656 per year, straight line, interest. Calculated on the liability balance at the start of year 6, let's say it's around $8,124 for this example. Total year 6 expense, finance lease, $31,656 plus $8,124, which declines, $39,780. Now compare that pattern. Finance leases have higher total expense early on, high interest, which declines. Operating leases have a constant straight line expense. But if you add up all the expenses over the entire 8 years for both methods, the grand total will be identical. It's just about the timing and classification. Finance leases front-load the expense recognition. Operating leases smooth it out. Understanding this helps immensely when comparing companies or analyzing trends.
And quickly, that policy election for short-term leases.
Right. Lessees can choose not to capitalize leases of 12 months or less. No ROU asset liability. Big simplification. Must apply it consistently by asset class. Can't use it if there's a purchase option you're likely to exercise.
Okay, got it. Finally, presentation and disclosures. Where do these ROU assets and liabilities actually land on the balance sheet?
A couple of options. They can be separate line items like operating lease ROU assets or finance lease liabilities. Very clear. Or they can be included within other existing lines, like ROU assets under property, plant, and equipment. But if you do that, you must disclose in the notes which line items contain them and the amounts. Lease liabilities always get split into current and long-term portions. And a huge point. You cannot mix operating and finance lease assets liabilities together on the same line. They have to be presented separately or disclosed separately because they represent different economic realities.
In the amortization of the ROU asset itself, are there specific rules for how long you amortize it?
Yes, and it depends on why it was classified as a finance lease based on use. If O or ownership transfer, or W, your purchase option reasonably certain was met, you amortize the ROU asset over the asset's useful life, because you're essentially going to own it or keep it for its full life. If N, NTV, E, economic life, or S, specialized asset, was met, you amortize over the shorter of the lease term or the asset's useful life, because you might only control it for the lease term, even if its physical life is longer.
Let's use the Cooper Industries boat example, 5-year lease. No ownership transfer, no purchase option. But PV of payments equals fair value, N is met. Boat's useful life is 7 years. How long does Cooper amortize the ROU asset?
Okay, N is met, so it's a finance lease. We use the second rule, amortize over the shorter of the lease term, 5 years, or useful life, 7 years.
Shorter is 5 years.
Exactly. So Cooper amortizes the ROU asset over 5 years. Shows how the lease term caps the amortization period in these cases.
Makes sense. What about the income statement presentation summary?
Quick recap. Operating leases. Single lease expense line, usually straight line, in operating income. Simple. Finance leases, 2 separate lines. Amortization expense for the ROU asset and interest expense on the liability. Shows the components.
And the cash flow statement. How do the payments get classified? This always seems tricky.
It is tricky, but critical for analysis. Operating leases. Pretty much all cash payments, base rent, variable short-term, go into cash flow from operations, CFO. Exception. Cash paid to get the asset ready for use, like major installation, goes into cash flow from investing, CFI. Finance leases, it's split. Finance leases. The principal portion of the payment, reducing liability, goes into cash flow from financing, CFF, like repaying debt.
Yeah.
Finance leases. The interest portion goes into cash flow from operations, CFO, like interest on debt. Finance leases. Any variable short-term payments not included in the liability calculation also go to CFO.
That CFF versus CFO split for finance leases is huge for analysis.
Absolutely. It separates debt repayment from core operational cash flows.
Okay, lastly, the disclosures in the notes. What kind of extra detail do companies have to provide?
A lot. They're crucial for understanding the full picture. They fall into 2 buckets. Qualitative disclosures. These are the narrative bits. Describing the nature of the leases, restrictions, covenants, how variable payments work, details on extension termination options, residual value guarantees. Also, significant judgments made like how they picked the discount rate or allocated components. And info on sale leasebacks or short-term lease policies gives you the story behind the numbers.
That's quantitative, the hard data.
Right, quantitative disclosures, specific numbers. Things like total finance lease cost, broken down into amortization versus interest, total operating lease cost, short-term lease cost, variable lease cost, actual cash paid for leases, split by operating financing flows, non-cash info, like value of new ROU assets acquired, weighted average remaining lease term, weighted average discount rate, and maturity analyses showing expected payments year by year for the next 5 years and totals after that separately for operating and finance leases. Allows for really deep analysis and forecasting.
Wow, okay. That is a ton of detail required.
It really is. It provides significant transparency into what can be very large obligations for companies.
Phew, what a deep dive that was.
Yeah.
We've really gone from the absolute basics of what a lease is through those critical ONI-RISH criteria for classification and all the way into how these deals actually hit the balance sheet, income statement, cash flows, and those detailed notes. I feel like you definitely have a solid grasp now of lessee accounting.
Yeah, and hopefully you see this isn't just, arcane stuff for accountants. Understanding these principles really helps you decode financial statements much better. You can assess a company's true leverage, look beyond just the reported debt on the balance sheet. It can even help you make better decisions in your own business or personal life when you're weighing up leasing versus buying something significant. It's really about seeing the financial story that lies beneath the surface numbers.
And here's something to chew on. Considering how specific some of these rules are, especially those bright line percentages for classification, like the 90% NPD test or the 75% economic life test, how might companies strategically structure their leases? Could they aim to fall just under those thresholds to achieve, say, operating lease treatment, if they prefer that look on their financials? And what does that potential for strategic structuring mean for you as someone trying to understand a company, whether you're an investor, a potential partner, or just, curious about how finance really works? Something to think about. Keep exploring, keep asking questions, and keep deep diving into the world around you. We'll see you on the next deep dive.